Well, hi, I'm going to try to go over 11-2A for you. Hopefully that will make it easier. I Unfortunately, I can't make it go back to blank, so I can't work it out in that way, but I'll talk you through how I got each of the answers um, and see if that's helpful to you. Anyway, sorry you've had so much trouble finding help. That stinks that the help system that's set up isn't able to meet your needs a little bit better. Anyway, so let me just kind of talk through this a little bit. So here we have the Novak Corporation. Here's their stockholder equity accounts at the beginning of the year, January 1st, 2017. And then there's all these transactions during the year, and they want us to record those transactions. So the first one is they issued 5,000 shares of common stock for $30,000. So because this stock has a $4 stated value, um, we know that we're going to have to record some of the common stock at the stated value plus any additional value beyond the stated value. So how we do that is we just say we're going to debit cash for the full $30,000 that we get for the stock. And then our common stock account, we will take the stated value of $4 per share times the number of shares, 5,000 shares. So the stated value of our common stock is $20,000. And then any amount over and above that, which would be $10,000 to add up to the $30,000 in cash we got, would be listed as paid in capital in excess of the stated value on the common stock. Then on March 20th, we purchased 1,000 shares of common treasury stock at $9 per share. So treasury stock is just stock that has already been issued and is out there being traded on the market, and we're buying it back into the company. So when we do that, we're going to debit the treasury stock account, and then we will credit cash because our cash will go down because we're buying the stock, and our treasury stock will increase by 9,000. On October 1st, we declare a 6% cash dividend on the preferred stock. So to do that, we just take the value of the preferred stock, $300,000, multiply that by the amount of the dividend, 6%, which gives us $18,000. And then we're going to debit the cash dividends account, 18,000, and credit the dividends payable account because we haven't paid the dividend yet. Then on November 1st, we pay the dividends declared on October 1st. So we will debit the dividends payable account, right? Because it's no longer going to be payable, and we'll credit cash. On December 1st, we declare a 45-cent per share cash dividend to common stockholders. So the trick to this one, this is probably where most people are going to get hung up on this problem, is figuring out how many shares of common stock we actually have. So to do that, we have to kind of look at what we had before. So we had common stock with a $4 stated value and a $1 million in value at the stated value. So I'm going to take the $1 million and divide that by the stated value, and that will give me the number of shares outstanding at the beginning of the period. So 250,000 shares will issued, and then less any treasury stock, and that will give us the number of shares outstanding. So at the beginning of the period, we had 5,000 common shares in treasury stock. That means we had 245,000 shares issued and outstanding. Now on February 1st, we issue an additional 5,000 shares. But then on March 20th, we purchase another 1,000 shares treasury stock. So in the end, we have 249,000 shares issued and outstanding. Now we're ready to apply the amount of our dividend, which is 45 cents per share, figure out our total dividend, which is $112,050. So our entry is just going to be to debit cash dividends, $112,050, and then to credit dividends payable, that same amount. Then on December 31st, this isn't clear from the way they structured this problem. I think it's a little confusing. It just tells us that we determined our net income for the year was $280,500, and that we paid the dividend declared on December 1st. So from that, we're supposed to infer that they want us to close our net income to retained earnings. So they want us to do an entry where we debit income summary for the amount of the net income, $280,500, and credit that to retained earnings. Again, I don't think that's very clear, mostly because in real life, we would have been entering that that revenue the whole year, and so this just makes it confusing. And then we would have closed revenue to income summary, and then we would have closed income summary to retained earnings. They just have us skipping that straight to closing income summary to retained earnings. And then we also have to close the cash dividends account to retained earnings. So to do that, we're just going to take the value of our cash dividends account, which we debited $18,000 here, and we debited another $112,050 here. So we have $130,050 as a debit balance in our cash dividend account. So to close that, we'll credit cash dividends $130,050, and we will debit retained earnings that amount. Finally, they want us to record the payment of the cash dividends payable. So that was back here on December 1st. We had dividends payable of $112,500, a credit balance. So we'll debit that, and then we'll credit cash because our cash is going down because we're paying the dividend. And that's it. I hope that's helpful. If you're still having a hard time, you can give me a call or text me, and I will try to help in whatever way I can. I hope it was helpful, and have a great night.